All right, so we're talking about raising capital, and it's incredibly important. I took my company from what we affectionately refer to as the closet, a 400 square foot location, and we were able to scale that to now we're serving in stadiums. We're partners with Charlotte FC. We're now growing into our 10th location and still expanding. And none of that would have been possible without OPM or other people's money. So this is something that I'm super passionate about. I've got a lot of experience with, and I'm really excited to be able to share everything that I've learned about that. One of the things that I hear when we talk to small business owners all the time is, I don't know where to start. Some of the fears are, what if they say no? Or in my case, what if they say yes and I screw it up, which is something else that I've also got experience with. I've done that too. I hear frequently, I'm not ready yet. Well, let me tell you what. In some ways, you're never ready. You're never ready for the responsibility of managing somebody else's money for your business. But it's something that you've got to do anyway. So my job today is to be able to help you understand the process as best we can. And then there's probably going to be more courses and classes later where we'll dive into very specific details on certain parts of this that maybe resonate with you in whatever part of your journey that you're in. We're going to talk first about the investor game. And so, what I want you to walk away with is to have some understanding of knowing what the investor is actually looking for. You need to understand what is their ROI or their return on investment. They're not just giving you money just because they like you, they want something from you. What is that return going to look like? We're going to talk super briefly about risk mitigation. We're going to talk about your story behind the numbers. We're going to work through and make sure that you understand and have a plan for your ability to exit. That's another thing that investors are looking for. It's super important. And we're going to talk about the strength of your team. Now, bear in mind, as I go through a lot of this stuff, my goal for today's class is not necessarily to really take you super far down the path in any one of these, but it's really to kind of paint an overall picture so you have some understanding of what this whole idea of raising capital looks like. And you can understand what the investor is going for, what you need to learn with pitfalls, so that you have a framework of what to do and can help you ask better questions maybe down the road, and just feel comfortable with it. Even the terminology. Some of these things are words or expressions that maybe you haven't used before, maybe you have, but we're going to talk about the context around that. So that's kind of what I'm doing today, is kind of breaking down some of those barriers and myths. When we talk about myths, we're going to talk with 5 things right off the bat that are fundraising myths. And I'm going to take you through this really quick. Myth number 1 is that investors only care about the numbers. And I'm here to tell you that is not true at all. They actually care about people, they care about your purpose, and they care about the story behind your numbers. You need to be able to articulate that story about why your numbers do or don't make sense. And I can tell you from experience that the numbers don't always have to make sense. If you go back and look at some of my P&Ls from the last 4 years, just the P&L on its own, profit and loss statement, doesn't make any sense. But the story behind those numbers is a completely different thing and has enabled me to be able to raise, like I said, almost $2 million in capital. Myth number 2, you need to be perfect before you raise. Not true at all. Investors invest in momentum, not perfection. There's a couple things that I want you to be able to take away from today, and that's one of those really big things to take away. Investors invest in momentum. So you don't have to be perfect. Don't worry about that. You're never going to get to be perfect. But as long as you've got forward momentum and you can articulate that in a clear, concise manner, then you're already light years ahead of other people that might be vying for that same investor's money. Another myth, and I hear this one all the time, taking money means losing control. Also, not true. With the right structure, capital, other people's money, is a tool. It's not a trap. Sure, there are scenarios where you could give up control, you're going to give up equity, but it doesn't have to be that. And I think there's this very common misconception that if you are giving up equity, then you no longer have the ability to run or manage your own company. Not accurate at all. We can dive down that rabbit hole later. Myth number 4 is I need investors that care about my specific product or have experience in my industry. Also not true. Almost all investors are betting on the jockey, not the horse. And again, this is going to go back to that story more than the numbers. Is it helpful to maybe have somebody that understands your industry and has experience? Sure. They're going to be able to give you advice and counsel, and maybe they're a little bit more astute of an investor because of their experience. But the reality is, if you've done your job correctly when you're raising capital, they're investing in you as a person in your ability to execute, build a team to lead your company forward, not in your actual company or product. And then myth number 5 is I need huge revenue before raising capital. Also, just not true. You can actually have very little or even be pre-revenuing with the right type of investor. The first $80,000 I ever brought on, we had made maybe a couple $100 at farmers markets. We didn't have solid revenue. And even now, sometimes the money that I'm raising sometimes is actually more. Like right now, it's going to be more, half of the revenue for my entire year. The revenue is not as important if you have the right type of investor and you can understand that. Another big thing is not all money is created equal. Taking money is like taking a business partner. So understand that. Again, they may or may not have a say in your company, but you now have a responsibility to work with this individual who has trusted you with their hard-earned cash. And every dollar comes with expectations or strings or both. Now, that shouldn't be scary because if you do your job correctly, and this is one of the things that we'll talk about, you have the ability to decide what those strings are. And if you do this intentionally, you get to set the expectation for the investor. And so if you have an investor who has a different set of expectations than you, then guess what? You don't have to take their money. It is a give and take. And so you need to have a really clear idea of what those strings or expectations are. But just know that the second somebody gives you a check and you cash it, there is a string or expectation attached to that. And if you go back to the beginning, remember that most likely expectation is an ROI. It is a return on their investment. That is what they're expecting from you. To give you a little bit of an idea of what the capital spectrum looks like, I'm going to just run through a few different types of capital that you can bring on. There's going to be a presentation that goes with this. There's be more detail, so I'm going to keep it super high level so I can focus on some other things. But just so you have some idea of what the different kind of buckets that you might be able to raise capital in, especially from an investor standpoint, these are terms that you should probably get familiar with and be able to associate a certain type of investor maybe with one of these buckets. So on the capital spectrum, we've got bootstrapping, which is exactly what you think. It's using your own money to grow. A lot of entrepreneurs do that. You've got convertible instruments, which are safes or notes. So we'll go down that rabbit hole again in kind of a different lesson, but there's a lot of things that you can do with a safe or a note. Those do become convertible. You've got debt, which is just taking on a loan. Sometimes, like if you're not doing it with a bank, and let's say you're going to go to an individual who's going to give you money as a loan, that would be considered a promissory note. That note can be convertible. So you could potentially pay it back with principal and interest, or you could potentially convert it to equity down the road, or a combination of both. I've actually done both of those things and combinations. And then you've got equity, and that is where somebody gives you money for a percentage or shares or stock in your company. And so that's kind of the 4 different types of capital that you can take on and what you're trading for each one of those. Then you've got the investor spectrum. And so this particular spectrum is going to be early to mid-stage investors. So these are the guys that are kind of pre-revenue or you're just revenuing a little bit, and they want to come in kind of early on to be able to work with you. You've got your friends and family. Most people are going to tell you to start with friends and family, which to some degree I don't disagree with. But you've really got to understand, and we'll work through this at some point, there's a different level of strings and expectation that comes with friends and family. It can be easy money to get. It can be hard money to get rid of. It's just very different when you're dealing with people that you know and have a relationship with outside of business. So that's one, you got friends and family. Then you've got venture capital, or what we call VCs. Those are going to be larger firms that pool their money together as in groups of investors. The firm then decides who they are going to invest in, and you're kind of taking this conglomerate of investors who usually take a stake in your business. Again, there's pros and cons to that. It just depends on the stage of your business, but I would certainly do some research into venture capital. Then you've got angel investors. Angels is really kind of my area of expertise. It's the one that I've been the most comfortable with, and those are typically high net worth individuals, and they've got to meet a certain criteria to be an angel investor. I believe, and I could be wrong, but I think they need to have over $1 million in assets and like $200,000 liquid to be considered an actual angel investor. And so those are people that are maybe more socially conscious. They might participate in venture capital someplace, but then they'll also do investments on their own. And then you've also got crowdfunding, and crowdfunding is exactly what it sounds like. That's when you put your idea out there, and a bunch of people from potentially all over the place put in small amounts of money for typically a product that may not even be released or launched yet. On a larger side, so this is more growth focused and later stage companies, you've got strategic or corporate investors, and that's where your large companies like a Nestle or an AT&T, somebody like that may buy a portion of your company. It's usually equity, and they're investing for strategic alignment down the road because they see something in your business. You see a lot of family offices. Family offices is kind of that really cool mix between the angel investor group and the venture capital group. And those are usually, again, high net worth families that have kind of built a legacy around this. A lot of times it's geared towards a specific industry like the health industry or real estate. You've got private equity, which is kind of like the venture capitalist, but at a little bit larger scale. Private equity is again going to be usually later stage, or as you're even potentially exiting. Those are the people that a lot of times would be ready to buy your company. And then you're going to go back to on the capital side, we talked about debt, and so on the investor side of that debt, it's going to come from banks or lenders. And there's all kinds of things for that. You've got the SBA, through the government that can do lending. You've got actual banks that will do debt, depending on whether it's equipment, it's collateralized, or is it for expanding and growing your company. And then you've got some of those third-party companies as well, or just lending institutions that may be willing to give you some money, again, if you are operating in an area that they specialize or know really well, and they feel like they've got a really good chance of kind of mitigating your risk. So that gives you a pretty decent breakdown, and I know I went pretty quickly. Again, there's going to be a deck that you can go through that will go in a little bit more detail, but that's kind of a brief overview of what kind of capital is available, and then what kind of investor group is going to potentially supply capital from each of those areas. Next, we're going to end up talking about things you have to know before you pitch, but I wanted to make sure that we at least got that really good, solid starting place on the capital and investor side first. All right, so let's talk about some things that you need to know before you pitch, and some things that you need to understand about your own business. So you need to know what stage are you in? Where are you in your growth? Are you pre-revenue? Are you revenuing? Are you growing? Are you scaling? Be able to talk about that and understand that, because knowing where you are in your business will help you identify the right type of investor for your business. You need to understand your speed. How fast do you need to move? That's also going to help you understand how much cash or capital do you need to bring on board. You need to understand your timing. So for how long do you need money to be able to scale? A lot of times in the industry, we call this your burn rate. How long are you going to burn money? And your burn rate also is, in correlation with your run rate. Like, how long can you go with how much money? If you brought on $50,000, but that only lasts you 6 months, but you need 12 months to get stable, well, then you actually need to adjust some things so that $50,000 lasts longer, or if you need $100,000, not $50,000. So understanding those things are super important. And then really big, and this is going to go back to one of the very first things I already mentioned, so you're going to see a theme here, is you need to have your exit vision. So ROI planning. Where are you headed? And again, where do you and this potential investor get a return on the investment? So there's going to be a picture that we're going to put up that talks about the 6 pitch pillars. And so I'm going to run through those very briefly. And again, there's probably going to be some further explanation for each of these down the road. But as we talk through these, what I want you to understand is this is not new. This is not great. This is out there on the internet. It's on Google. You can find it in ChatGPT. So understand that this is less about the academics of what I'm talking about and more about the application of what I'm talking about. It's about making sure that you are partnered up with somebody that has been through this, done it, and understands, and can take the academic pieces of what is readily available information online and be able to move forward in a way that you can actually apply it and then go raise money, right? So you've got your 6 pitch pillars. We're going to talk about traction. You need proof that you can execute on your plan. That proof, it looks like revenue sales, it's customer user numbers, it's partnership contracts, it's press media socials. It's proof that your business is tangible and it's real and that you've got traction and that you're growing. You're going to talk about your market. You need to make sure that your market is big enough, that it's bold enough, that it's specific enough. I see so many entrepreneurs that want to tackle everything. And there's this saying, the riches are in the niches. That's a real thing. Like, you need to be able to pull your market down and still make sure that your market has enough size for your business to enter that space. Do you have a differentiator in your specific market? Is there somebody out there that can do what you're doing, and can they do it faster or better? Those are all things that you need to understand about your market and your competition. You need to be able to talk about your story. Why you and why now? Remember when I said that investors, they're really investing in the jockey, not the horse. So that story is super important, and you need to be able to communicate that story clearly and efficiently on why you are the person, why your company is the one, your product is the one. I said that numbers is not the end all be all, and that's true. However, numbers are important. So you need to be able to understand and articulate your financials in your pitch. One thing here is clarity over complexity. It doesn't need to be crazy. You need 3 to 5 year realistic projections, and you need to be able to explain how you got there. I'll pause on that because this is one of the most common things I see all the time, and this is a huge mistake. People say, I'm in 2025, I'm doing this much money or this much revenue, so by this time next year, I'm forecasting we're going to be at X. Okay, great. I can forecast that it's going to rain tomorrow. That doesn't mean that it actually is. How do I know that? So you need to be able to talk about how you're getting to that what, and that what is that future goal. You need to understand what your gross margin is. How much money is left over after you have spent and bought your ingredients, or you've gone through your cost of goods or whatever. What is your actual margin, gross margin and net margin? We talked about your burn rate briefly. Again, how long is this money going to last you? The first 4 years of my company, we spent more than we made every single year, sometimes by a couple $100,000. That's a pretty significant burn rate. You need to be able to understand that. We talked about your runway, cash flow, and projections. What is your path to profitability or an exit? Again, I'll say this one more time. Focus on the how, not the what. Anybody can come up with a what. Hows will really set you apart and get you significant more interest from those potential investors. The team is one of your pitch pillars. You need to be able to understand and be able to communicate who your team is. Who is building this with you? Sometimes it's just a solopreneur, but more often than not, especially if you're taking on capital, your business is at a place where you are trying to scale. And to scale, you need people to help you do that. What is your role? Who is helping you, and for how long are they helping you? Who do you still need to bring on board to get to the next level? How do you attract and retain that talent? Having a really clear understanding of where your team is now and what your team needs to look like down the road is one of those major pillars that instills confidence in an investor to be able to work with you. And then the last pillar of your pitch is the ask. And you would be amazed at the number of entrepreneurs that I see that miss this super simple final pitch. They get all this information together, and then their ask is not very clear. What are you asking for? Why are you asking for it? How much do you need? What are you using it for? And then what's in it for the investor? So we keep coming back to this, what's in it for the investor. That goes to that string or the expectation. That goes back to that ROI for the investor. so many times I think entrepreneurs are worried about what they're getting out of this, what they need, which is fine. You need to think about that. You need the cash. But here's where the give and take is in building that relationship with investors. They need something too. They need to be able to trust you. They need to understand your story. They need to understand where you're headed, and they need to know that they're going to get something back from you. Let's talk really briefly about some common pitch killers, and I'm just going to kind of run through this list. Overcomplicating your deck, too many words. So I just gave you 6 pitch pillars. I've seen some people, they'll take those 6 pillars and then they'll end up with a 40-page slide deck. That's way too much, or there's way too many words on it. Your deck should be designed to go along with you as the owner of your company talking through it. It's more of a storyboard, and then you are the narrator. Your deck should not be the actual narration, so keep it simple. Another common thing is hiding weak spots. Don't hide the weak spots. Put those at the forefront, because likely that's one of the reasons that you need money, is you need money to be able to focus on that and strengthen or shore up those weak spots. Going on too long. A really good pitch should be somewhere between 6 to 8 minutes, depending on what you're talking about, or if your idea is a little bit more complex, maybe 10 to 12. If your pitch has gone on for more than 15 minutes, then you've taken too long. So you need to be able to understand how to cut that down. Common pitch killer, not knowing your numbers. Again, I'm going to stress on that. It's not what the investor is necessarily ultimately going to invest in. They're investing in you, and they need to know that you know your stuff. They may not ask you questions about your numbers down the road, but they need to trust you. Being knowledgeable and understanding your numbers is critical. And there's nothing worse or more embarrassing than you're going through a pitch, you've got a great flow, and then an investor stops you and says, well, hey, can you explain how you got to that net margin? And then you're totally blank and you have no idea what they're talking about because you didn't prepare for that. Know your numbers. And then another pitch killer, not having a clear enough plan. When your plan is vague and not actionable. So again, a way to make sure you have a really clear plan is to focus on the how, not the what. Your what is, you're going to triple your revenue by the end of the next, 3 quarters. That's great. How are you going to do that? What's the plan to make that happen? That's what they care about. It's also important to understand that relationships really matter when you're building your company. And matter of fact, relationships matter more than the capital itself. Money is easy. Good money is rare. Good money with great people is the ultimate unicorn that everybody is searching for. And the reason why is because the right money will come back with more money, even if you lose their money the first time. And I've got multiple examples of this. Not every venture that I've started or been a part of has been successful. I have, even in my main company right now, Knowledge Perk, we have taken on new locations and took on $100,000 in investment and lost every penny of it. And every single investor who lost that money with me has reinvested again and is still a part of my company today. And it's because we built it on a real relationship and not just this, idea of they're a bank for me. I heard this a long time ago, and it's always stuck with me, and I love this, and so I hope it's helpful for you as well. But if you ask people for money, you'll get advice. Ask for advice, and you'll get money. And so if you can understand that and you think through that as working with potential new investors and building a relationship, you're really working for the advice, their experience, how they can potentially help you or work with you. And if you have a really great intentions around that, then very likely, more often than not, the money will follow. If all you're doing is asking for that check and there's nothing else that's a part of that, then you're not going to get anything else. There's a doorbell going on behind me. That's okay. Relationship capital. That's a word, it's a phrase that we've heard in the past, but it's a real thing. You don't always have to buy the building if somebody can open the door for you. And so I think it's also important for entrepreneurs to understand that capital does not always have to be cash. Influence is every bit as valuable as money. And so operating in kind of the way that we're talking about with a real relationship and building that relationship, it's important to remember and understand that relationships actually matter more than capital. A lot of times investors not investors, entrepreneurs are just thinking about the money. And you really got to open yourself up to understand that it's more about the cash capital. The relationship capital is just as important. Money is easy. Good money is rare. And good money with great people is the unicorn. And that's what each one of us should be after, is how do you find good money with great people? The right people will come back with more money, even if you lose their money the first time. And I know this by personal experience. We opened a location that didn't do well. I had investors put $100,000 in. We lost every penny of it and then some. And those same investors have reinvested with us again and are still happy investors in my company. And it's not that they're thrilled that I lost the money, but things happen. It is business, but we kept the relationship. We were honest with our weak spots. We learned. We paid attention. And then we were just really transparent with the process. I heard this a long time ago, and I loved it, and it's always stuck with me, so I'll share it with you. But if you ask people for money, you'll get advice. Ask people for advice, and you'll find money. And if you can kind of operate with that idea in the back of your mind that, you're building these relationships with investors and they have so much they can offer with experience. They didn't get money to be able to invest in other people with no reason. So look at that as a way to be able to grow your capital and your business as well. And then as you build those relationships and they kind of mentor you, you'll be amazed at the number of people that want to support you with more than just that advice and that mentorship, but their money will follow. And then remember, relationship capital is a real thing. I love this idea of you don't always have to buy the building if someone will just open the door. Influence is every bit as significant as actual cash, sometimes even more so. And so don't think that just because somebody maybe didn't give you a check that they can't be huge assets to your company. The relationship and their ability to open doors for you is every bit as powerful as the money that they may or may not give you. And if you treat them that way, your chances of them actually giving you money goes up significantly because, again, you've built that relationship and you understand the value. So to say, okay, Ryan, we talked about different kinds of capital. We've talked about different kinds of investors. Like, where do I find the right investors? Like, how do I go find and meet these people? It's actually simpler than you think because they're all around you. It is your network. It is referrals. It's warm intros. It is your friends and family. It's asking friends and family to introduce you to other people that can give you some advice. Remember, ask for advice, get money. Find people who may be interested in your business. Sometimes it's industry events, it's conferences, there is pitch events. There's a lot of resources online. There's places that you can go with, deal exchanges and that kind of stuff. So if you're willing to put yourself out there, there's definitely places where these investors are on a regular basis. There's strategic outreach. There's research and personal touch, reaching out to somebody on LinkedIn, understanding who is likely to invest in your business or who knows a lot about your industry, reaching out to them for support and advice or mentorship, and then seeing where that relationship goes. Again, relationships matter. And then the number one way, and people sometimes think this is crazy, but from my experience, this has definitely been the case. The number one place to meet potential investors or build relationships that can turn into investors is volunteering. Wealthy individuals a lot of times want to do something more than just use their money. And so you'll find them volunteering for their local charity, their local nonprofit, and getting in and doing an activity more than just writing a check. And so whether it's working or volunteering with your local chamber or any of the local nonprofit organizations, get in and get involved. And what that does is that it tells investors about you as a person, that you care about your community. Again, they're investing in the jockey, not the horse. And so it sets the stage for building the right kind of relationship. You get to meet them in a way where you're serving for others, which again, this is about building a relationship. It's a great way to be able to start telling your story in a non-manufactured format that just feels very real and very genuine because you're there for the same reason, the same purpose. And I can say, if I go back and look at the number of investors, and I think currently I've worked with 25 plus investors. I have over 20 investors in my company right now. So probably more than that, more than 30. Every single one is a connection that came from volunteering in some way or capacity. Every single one. So when you're trying to figure out where to find the right investors, go out and serve your community, and chances are they're all around you. Couple other things really quick that you should know is you need to date before you marry. That's just as important in raising capital as it is in real life. Some green flags is vision alignment. And again, you've already got a great green flag on vision alignment if you met them while you were volunteering. You're involved in the community, so there's a green flag right there. That they're a value add, so they do understand something else besides in your business besides just be able to write a check. They're a long-term thinker, or they've lost investments before. And you say, Ryan, that's a weird green flag, but it's true. You want somebody who's not afraid to lose their money and has done it before. So you don't have to be the first person that they've lost that money with. They've already dealt with it. They have some understanding around it. And they're probably going to ask you different questions because of it. Red flags is control grabs. If the first thing that they want to do is say, hey, I want to vote or I want to seat on your board or something like that, for me, that's an automatic red flag. Like we haven't even got to that point yet. I need to know and build some trust and rapport with you in my business before we ever get there. If they've got a huge ego, again, some of those people that maybe you don't meet volunteering, maybe they've got a big ego. If they got an ego, that's not going to be great for you and your business. That's a red flag for me. If they're always involved in some kind of drama or they're asking questions that incites drama with other people, red flag. If they focus on the wrong details, if they are focused on certain numbers or small things that don't really matter, because again, they're not that big thinker. They're not thinking long term. They're thinking tomorrow. It's a red flag. And then if they're a first-time investor, the reality is you don't want somebody who hasn't done this before and understands it. Can you take somebody's money for the first time? I'm sure, but would I recommend it? Absolutely not. And then you've got to be able to deal with them after they've already given your check. So, what does managing that relationship post-check look like? One, over communicate. Frequency more than details. They don't need to be all up in your business all the time, but you need to understand and have a commitment on the front end that you're going to communicate with your investors frequently and clearly, just little touches. This is something that I struggle with sometimes, and so this is a reminder to me as much as it is to you. Trust me, use my experience. Share wins and losses. So sometimes what you screwed up is actually more important than what you got right. I've got several instances of this in the past, so understanding what you can do better or different next time. Make them feel a part of the journey. And so whether that's, occasionally tagging them on social media or, just a quick phone call, say, hey, I'm driving, I got some drive time, this just happened and I want to touch base with you. Just include them when and where you can, where it makes sense. And then stick to a communication style that was agreed to before you got the check. So this is one of those big parts about, setting the expectation on the front end and the strings that are attached to that. Communication is a part of that. So understand that. We got fundraising screw-ups, okay? What are some of the things that I have learned or some of the things that you need to be on the lookout for when you are raising capital? There's a list that's going to be up on the screen, but it's anything from overvaluing your company, undervaluing your company. So you've got to be Goldilocks. You got to get the value of your company just right. Hiding bad news, which we talked about that. You want to put those weak spots up front. No clear exit plan or even a really strong long-term plan. Not knowing your numbers. No clear use of how you're going to use the funds that they're going to give you, what you're asking for. And then a big one that I see all the time is not raising enough capital. So again, not understanding your burn rate and that runway. You think that the money is going to last you 6 months and then all hell breaks loose and you actually need it to last you 12 months. And now you've already gone and pitched and done everything and you didn't raise enough money. So there's a lot of things that you can do wrong. And so hopefully this is kind of helping you think about what questions to ask. What do you need to understand? What should you be working on to avoid all of these pitfalls, most of which I have already made, and I'm pointing out to you now so that you don't have to do the same thing. So your next 3 steps. So if you want to continue going down this road and, I haven't scared you and this is helpful for you in some way, build your investor target list and where to meet them. And so again, if you know that you're targeting high net worth individuals that have this whole list of green flags that we went through, then chances are you need to spend more time in the community, more time volunteering. You probably need to go to a couple of events. Be intentional. Use this information to help you figure out who you need to go talk to and where you can go find them, and then go meet them. Start building a relationship. The relationship comes long before the check does. Tighten your pitch and practice it. I just gave you 6 pillars that are very simple, but they are foundational to actually putting together a really good pitch. go back through, listen to those. Again, there's plenty of resources online. I'll probably do some extra resources and maybe take you through some of those pitches, but put it together, practice it in front of a mirror, in front of friends and family. Know your stuff and be so comfortable with it that you can give that pitch anytime the opportunity presents itself. And then get clear on your ask and your exit, or how they get a return. That is so absolutely critically important. The last thing I'm going to leave you with, and this is a thought for you to constantly keep in your mind if you're interested in raising capital, and it's this idea of reframing what you're doing. You're not begging for money. You're offering a seat on a rocket ship. And that thought, that belief in yourself is so critical. You're not out there pinching pennies and hoping somebody gets you a check. This is an Oliver Twist. Like you are about to board a rocket ship. You've got 5 seats left. Somebody is going to the moon with you. Who gets to be that lucky person? And that mentality, if you can constantly have that in the back of your mind when you're meeting people, that energy is almost infectious. It's contagious. People, they feel it, they see it, they understand it, and they want to be a part of it. Everybody wants to be on a rocket ship. So change your mindset. You're not begging for money. You're offering a seat on a rocket ship. I think that's all I have for this one. I know I touched on a lot of stuff very, very quickly. Again, if you're interested and you want to see more of this, then we can stay connected. The rest of my social medias are going to be up on the screen or on the deck. I'd love for you to follow me on Instagram, Facebook, check out my website, and then let me know if you want to see or hear more content like this, if you want me to dive a little bit deeper into each of those things, from promissory notes to equity to pitfalls to even taking you through one of my pitch decks. Love to hear your comments and feedback. I hope this was helpful. And go sell a seat on a rocket ship. Hey, if you're still here, then obviously you found it impactful, and I'm excited to be able to connect a little bit further. Do me a favor, go to my website, notquitethereYetGuy.com. There's a list of other resources there. There's other ways that I can connect with you one-on-one. If you found this impactful, I would like to be the person that can help you find that seat on your rocket ship. Plenty of services available. I'd love to work with you one-on-one. NotquitethereYetGuy.com. Give me a follow on Facebook, Instagram. I'm looking forward to see how I can help you.